Hello everyone, how are you? Hope you are all doing well. Welcome back to our sessions. Today we are going to have uh, with respect to ACCA financial management. Okay, financial management, and it's related to section A concepts. Okay, and we are going to cover with the topic working capital management. A brief overview about working capital management. Before that, I kindly request you all to subscribe to this channel, share this channel among your groups, people who are uh, having access. They will definitely get the benefit of this, and see till the end. If you find it interesting, value added to you, like this channel, subscribe to this channel, and the moment I will post the sessions, you can get notification. And it is a series, isn't it? The first two series you have done, 1, 2. I will put like this in continuous way, so that I have done 1 by, I think 1 by 15, 2 by 15, 3 by 15 means this is the third series. Okay, likewise I will follow the things so that you will not get confused. Coming back to the working capital management. Working capital management basically deals with, see what happens, you will have the balance sheet, is it right? In the balance sheet you have the equity component and you have non-current liabilities, fine, long-term liability, whereas in terms of here non-current assets. And now the things are, you will have current liabilities and current assets. Working capital management basically deals with current assets minus current liabilities. Reason is, the most important factor is we should have cash to manage, is it right? Cash to manage the business. That's very important. Cash plays very crucial role. Now, when you do the thing, the concept of financial management is, the financial management works basically on two important things. The first one is time value of money. The first one is time value of money, and the second one is opportunity cost. Yeah, the time value of money. The rule says that if you see here, when we are talking in terms of current assets and current liabilities, we are talking as the time progresses, the value of money will decrease. Now the thing is, how much you have to hold cash? Is it how much you have to hold cash? Are we holding cash more than in excess? Again, it's not financially healthy for our business. If you are holding less cash, definitely we will have issues with respect to payments, all those things. We should know what is the approximate balance we should maintain. That the rule says that if the cash balance increases, it will, what will happen? The profitability of the business will decrease. In the same way, if the cash balance is decreasing, the profitability of the business will increase. Now, to what extent we have to maintain cash? That's the thing which we are going to cover in this session of working capital management. First you have done from 1 to 19, then 20 to 44, and now 45 to the till the completion of this. We are just working out. In this we are going to cover with respect to some ratios with respect to inventory days. We have done efficiency ratios. In the financial reporting, you have done efficiency ratios. We will cover efficiency ratios. We will cover liquidity ratios. Is that? We will cover liquidity ratios. And one thing which we are calling is, we are talking about cash working capital cycle or cash operating cycle. Fine, my handwriting is not that much good. Okay. Any comments, anything to improve our way of presentation? If you find where I should improve, please let me know in the comments. By the end of July, you will get back the complete session of the financial management, including section A, section B, and section C. And in the month of August, I will take the mock exams. Fine. Now we will cover this. This is the basic overview. That is how the current assets and current liabilities, how to manage the cash. This is important. This is most crucial one. Is it most crucial one? Time value of money, cash. Is it cash? Fine. Now we will start one by one. This is section A. In the examination, you will have 15 questions in section A for 20 marks. For 2 marks each, it comes to 30 marks. Thrifty cash budget highlights is a short, they have a short-term surplus in the near future. They are estimating short-term. When you have the, I will make it very clear. When you have a short-term surplus, you have the short-term surplus, you have to match with short-term investments, short-term decisions, is it right? Short-term decisions, is it? That's very important. See, you should understand what is happening, and every question, every option, we have to understand, and we have to make sure that how it will be going to influence the, which of the following are the short-term pay suppliers early to take advantage of prompt discounts. Okay, what happens usually? What happens usually whenever you are buying a credit? See, when you are buying a credit purchase, fine. Whenever you are having a credit, see, there is a policy. You are paying within cash down payment. You are paying within 30 days. You are paying within 60 days. You are paying maximum, they say it is going to be 90 days. Fine, 90 days. If you are not paying 90 days, they will give you how much? 0% discount. If you are paying within 60 days, they will give you 2% discount. If you are paying within 30 days, they will give you 4%. Just I am taking it an example. If you are paying a down payment, total cash, they will pay you how much? 5% discount. When you have enough cash, you have a cash surplus, think about short term. Okay, think about short term surplus, short term cash with short term decision. Pay suppliers early to take advantage of any prompt payment discounts. Buy back the company shares. You see, it is a long term. And we will not buy back company shares with a small amount of surplus. Is right? Logically, it will not. Increase payables by see why you will delay payments when you have the cash. Is that you want to make quick payments? Is it? You wish to make quick payments. Fine. You don't want. If you delay, your cash balance will also. Invest in a long term. No. When we have a short term, you have to think in terms of short term. The answer is A. Likewise, you see, if you do like this, you will have just have a view about, read the study text of working capital management, and you will have more clarity. Next, I'm just following the same thing. Whether the following statements are true or not. Working capital. Working capital is nothing but current assets minus current liabilities. What are the current assets? You have inventory, you have receivables, you have cash. Is it right? What are current liabilities? You will have current liabilities in terms of payable. Increase, should increase. They say as this. See, definitely as sales increases. Is it right? As sales increases, What will happen? Sales increases. Is that sales increases? I will put like this. Sales increases, what your inventory will also increases. You need to increase your inventory levels. Sales increases, definitely your receivables will also increase. Sales increases, you will have your cash will also increases. Is it right? Sales increases, what will happen? Your payables will also increases. Right? That's the reason. If sales, what the say that working capital should increase as the sales will increase. An increase in the cash operating cycle will decrease profitability. I told you this is very, very crucial for us. Is that cash operating cycle is increasing? Is it right? Cash operating cycle is increasing. When the cash operating cycle should decrease, it should not increase. Is it? I'm giving. I will support every concept with a appropriate example. Is that it is a cash operating cycle. Operating cycle. What is the? You will have an inventory. You will have the receivables minus you have the payables. Fine. Now cash operating cycle is nothing but you are converting cash to cash. Is it right? You have to convert as quickly as possible. If you are taking longer number of days, it means you are not you are not efficient. Fine. Cash converting cycle. Take the example. You have 20 inventory days. You have 15 receivables days. You have 10 payable days. How much is there? 20 plus 15. 35 minus 10. 35 minus 10, it comes to how much? 25. You take another option, okay? You take cash. You take cash operating cycle is increasing, is right? You take the example, you take 25 days, plus you take 20 days. Here also you are taking how many days? 12 days. What will happen? 25 plus 5, 45 minus 12. It comes to how much? 45 minus 12, 33. Here what's happening? Cash operating cycle. Okay. The rule says that if the cash, is that the rule says that if the liquidity is decreasing, liquidity is decreasing. Fine. What happens? Definitely, if what the rule says, the profitability will increase. Is right? Profitability will increase. But what happening here is not like, see, liquidity is not affecting. You are converting cash in within 33 days. It's taking a longer period of time. Is that your cash balance will take 30 cash to cash takes 33 days. When it takes 33 days, definitely it will affect your profits. Your profits will decrease. Over trading is known as undercapitalization. Say, what is over trading? Very, very important concept. Very, very important concept. You will get one question on this over trading. Yeah, what the over trading talks about? Over trading talks about one minute. Is it? Oh, see, you have the current ratio. Is it right? What is the current ratio? 2:1. Quick ratio is how much? Quick ratio is 1:1. See, you have to support your working capital appropriately. You should not borrow more. You should not have an overdraft. Is it right? We should not have an overdraft. Now, what happens? We should see overdraft is healthy, but you should maintain that element in the balance sheet, financial statement. Now, if your current ratio is less than 2 and your quick ratio is less than 1, means you are borrowing more. Is that you are when it's happened means you are not supporting. Is that you are not supporting your sales with appropriate working capital. Is that over trading is nothing but not supporting not supporting the working capital decisions with appropriate working capital. Means no, that definitely means you are investing less in the working capital. It is under capitalization. Is it right? The answer is true. Which of the following might be associated with shortening working capital cycle? Shortening working capital might be associated. Low net operating cash flows. Yeah? Low net operating. See, net operating cash flows. What your inflows are less. Yeah, your inflows are less. Next, increasing tax allowable depreciation expenditure. It is whenever you say it is depreciation, it is a non-cash expense. Slower inventory turnover. See, slower inventory turnover ratio will increase. Is it? Will increase working capital cycle. Okay, will increase working capital cycle as such. Slower inventory ratio is nothing but you are taking the inventory days are increasing. Is that inventory days should not increase. I will put again the same thing, working capital cycle. Is it right? Inventory plus receivables minus payables. Okay, inventory is 20, receivables is 15 days. Okay, minus 10 days. How much is there? 25 plus 15, 35 minus 10. Is it right? How much it comes? 35, 25 days. 25 days. Fine. Now, if inventory days are increasing, is it right? If inventory days are increasing, is it? In inventory days, what will happen? Assume that inventory days are focus only on inventory. 15 minus 10, 45 minus 10. How many days? 35. The working capital cycle is increasing. It is not lengthening. It is not shortening. Okay, it is not shortening. This is not. It is also not. The lower net operating cash flow, definitely. What will happen? Your cash to cash conversion cycle is that cash to cash and cash to cash is increasing. Is it right? It is also not. Taking longer to pay supply. You are see what's happening. Take the same example. Okay, take the same example. Inventory plus receivables minus payables. Okay, 20 plus 15 minus 10, it comes to 25. 20 plus 15, taking longer period of time, it takes into 5. Is it at 35? 35 minus 5. 1 minute. 20 plus 15 minus 10. 35 minus 10, it comes to 25. Okay, 25 plus 15, 35 you are longer period, sorry, is it? You are taking 15 days, is it? You are taking 15 days. 25 plus 15, 35 minus 15, it comes to how much? 20 days. It comes to how much? 20 days. Is that? Means if you are taking longer period of time, you are what's happening? It is shortening the working capital cycle. This is the way you have to understand with respect to the concepts. Okay, with everything it should be supported with see, it will take time, but it will make a reasonable understand. Following what they are saying, they are talking about working capital cycle. Working capital cycle is what? Inventory plus receivables plus minus payables. Okay. Now what is the inventory? You have inventory three different components, is it? You have raw materials, you have work in progress, you have finished goods. Trade receivables is there, raw materials. Raw materials are how much? 6 weeks. Work in progress is 2 weeks. Finished goods is how much? 6 weeks. Plus. What is the receivables? Is that receivables is how much? Receivable 10 weeks. Minus. Okay? Minus. How much is the payables? Payables is going to be 7 weeks. It comes to how much? 6 plus 2, 8 plus 6, 14 plus 24 minus 7. It comes to 17 weeks. How many weeks? 7. A company sells inventory for cash to customers at a selling price which is below the cost of inventory. Is it right? Means they are selling their cost. Now what happens? What happens to current ratio? Is it right? What happens to current ratio and what happens to... See, it is very practical paper, okay? Current ratio and what happens to quick ratio. You have to be very, very specific with respect to understand. Current ratio is nothing but current assets minus divided by current liabilities. Okay? Current assets minus, current assets over current liabilities. Current assets over current. Now, first think about current assets. You are selling inventory for cash. Okay. What are the things in current ratio and quick ratio after the transaction? Each ratio will increase or decrease. Now make it a point. You make current liabilities as constant. Okay, because we are talking only in terms of, we are focusing on the inventory and cash. Okay, current liability is constant, receivables also constant. Fine. Current liabilities will be 10. Okay. Now inventory, take inventory as 20. Okay. Receivables will also be constant. Okay, receivables will also be constant. Receivables will be 15. Okay. You have the cash. Is that how much is the cash? Cash is going to be 5. How much is that? 20 plus 15. 20 plus 15. 35, 40. 40 divided by 10. What is the ratio? 4:1. See the next option. Okay, inventory, by having the inventory current ratio, inventory will decrease. Is it right? 15. The receivables will remain 15. Cash will remain 15. Okay, cash will remain. It comes to how much? 35. 35 divided by 10, 3.5. Is it right? 3. What's happening? The current ratio is decreasing. Okay, the current ratio is decreasing. Come back to the quick ratio. Quick ratio is, we don't have inventory. Okay, we don't have any inventory as such. Is it right? We don't have any inventory. 15 plus 5, 15 by 10. It comes to 1.5. You are selling for cash. When you sell for cash, cash will increase. Is it 15? Assume cash will increase to 10. Okay, total comes to 25. Is it right? 25 by 10. It comes to how much? 2.5 is to 1. Here in the quick ratio, it is increasing. Whereas current ratio is decreasing, quick ratio is increasing. This is the way you have to support your understanding. You have to put everything on paper. That's the most challenging one. Fine. Now, coming back to this, what is the and company has the following summarized statement of financial position. 31st December. They have given the things. Net current assets. How much is the net current assets? 450 minus 200, 250. Okay, over the next year, the company should double its sales. The company does not plan to invest in any non-current assets, but inventories, receivables, and payables should also move with the same line. Which means what happens? This thing 1, 2, 3 will also be double. Okay, what cash balance in year time would this imply if the non-current assets were all land and no new capital was raised and all profits are paid as dividends? All profits are paid as dividends. Is it? You have to be very specific. When we say it is the non-current, they are not maintaining anything. Is it? They are not maintaining anything as such. Means you take two columns. Okay, you take two columns. Is that this will be what? This will remain same 1000. Inventory will be doubled. Is it that? It will become how much? 400. Is it? The receivables will also be doubled. It will become how much? 300. 150 into 2. We don't know cash balance. We have the question mark here. They are asking us how much, what cash balance will be there. Is it right? This is going to be how much? 700. Next. Payables will also be doubled. How much? 400. Is it right? Payable will also be doubled as how much? 400. Next. Fine. That's all. Now we should want to know. It comes to next. Net current assets will be how much? Net current assets will remain same. Okay. 1250. Does not plan to invest in net non-current assets. Now what happening? See the things. How much is your current asset? You want to know the cash. You don't have cash. Is it right? Cash, what happens? Current asset. Whatever the amount of current assets minus current liabilities. Is it right? Current assets minus current liabilities. How much is the current assets minus current liabilities? 700 minus 400. This is the working capital. Is it right? This is the working capital for minus. You have the net current assets. Is it right? How much is the net current assets? 250. 700 minus 450. Means see the things. You have working capital is how much? 300. Is that working capital? But what net current assets are how much? Means in order to fill the gap. Is it right? In order to fill the gap, there is a 50%, 50 pounds dollars shortage. Is it right? This is the $50 shortage. This $50 shortage is not a positive balance, but it is an overdraft. Means when you take the things into consideration, what is the cash balance will not be there. Instead of cash balance, what you will have? You will have something called as a overdraft. Overdraft will be how much? Overdraft will be 50. Okay? Overdraft will be 50. Right? Next. Means what is the answer? Answer is you will have a 50,000 overdraft. Next. Gold Star has accounts receivable turnover 10.5, accounts receivable turnover. How much? 20 10.5 times. Okay, 10.5 times. See, what is the accounts receivables turnover? Formula is accounts receivable turnover formula is fine, we'll come to that. So accounts receivable turnover formula is 10.5 times. Is that 10.5 times is equal to 365 days. 365 days divided by 365 days divided by accounts receivables turnover. Is it right? Accounts receivables turnover. You will get what? You will get the 1 minute. You will get the days. How much is it? 365 divided by 10.5 times. Is it right? 365 divided by 10.5. It comes to how much? 34.76 days. They are asking you what is the accounts receivable turnover, inventory turnover. What they are asking you, what is the cash operating cycle? Cash operating cycle is nothing but inventory days, receivable days minus payable days. Okay, this is receivables. Fine, accounts receivables. Next, payables. Next, we will take inventory. Okay, we will take inventory. Next. Inventory also how much? 365 days divided by what is the inventory turnover? Inventory times how much turnover is how much? Inventory times, okay? Times, okay, how much? We have to take is a 365 divided by 4, okay? 365 divided by 4. It comes to how much? 91.25 days. Make it sure you don't forget about ratio analysis. If you know ratio analysis, almost these marks are within your graphs. Payables 365 divided by payables times, okay? Payables turnover in terms of times, okay? How much is there? 365 divided by 8. Is it? 365 divided by 8. It comes to how much? 45.63. If you take the working capital, is it right? If you take the working capital, fine. I'm just putting the thing. How much is the inventory? 91.25 plus receivables 34.76 minus 44.63. It comes to how much? It comes to 80.38. Or 80 days. Right? Next, cash operating cycle. We have done this. Is it? What is the receivables plus inventory holding period minus payable days. Minus payable days. Okay. Inventory holding period. No, it is not minus. It is plus. Okay. It is not minus. It is plus. Receivable days plus inventory holding. It is not minus. It is not plus. It is minus. Receivable minus payable. No, it is not minus. It is plus. Answer is A. Fine. Next. A company has annual credit sales of 27 million. Related cost is 15 million. What are trade receivables, inventory, trade, assuming what is the investment in the working capital. Again the ratios, okay? Again the ratios. The ratios are really, it add value to your marks, okay? It will add value to the mark. Next, first you calculate inventory. Is it right? Inventory. What is the, when you say it's a inventory, they say that cost of sales divided by cost of sales times how many days are there? They have given the days, is it right? Days by 365. Okay. Cost of sales is how much? 15 million. Is it right? 15 million times inventory is 60 by what they say number of days is 360 days. They have said it is going to be how many days? 360 days divided by 360. It comes to how much? It comes to 2.5. Okay, 2.5. Next, receivables. Sales times days divided by 360. Sales is how much? 27 million. Receivables are how much? 50 divided by 360. It comes to 3.75 million. Okay. Payables. Is that cost of sales into days by 360. Is it right? How much is there? 15 million times payables are how much? 45 divided by 360. It comes to 1.875 million. How much they say net investment required? Net investment required is how much? Net investment required is inventory is how much? Inventory is 2.5. Okay. Receivables is how much? Receivables are 3.75 minus payables. Payables are how much? 1.875. (2.5) plus 3.75 minus 1.875. It comes to how much? 4.375 million. Answer is what? Answer is okay. Next, a cash budget was drawn up as follows. They have the receipts, you have the payments. Fine. They have the receipt, they have the payment. Why opening cash? What is the receipt, credit, sales? What is the closing balance? Okay, just put it the things. You have to have October, you have November, you have December. Okay, total receipts, total payments. You put the things, how much is there? It comes to 30,000. Okay, it comes to 15,500. It comes to 20,500. Is it right? Next, if you take this into suppliers, wages, and this one, is it right? 20,600. Is it right? It comes to how much? 4, 6, 7, 7, 8, 8,250. Is that 8,250? It comes to how much? 10, 11, 12,700. Okay, 12,000. Receipts are how much? Receipts are 30,000, 15,500, 20,500. Okay, simple, very simple. Payments are how much? That is, payments are how much? 20,600. Okay, 8,250. Fine, 12,700. How much will get? 409,000. Is that 250? 257,000. Next, 800. 5,000. Okay, next, how much is the balance brought forward? Balance brought forward is how much? Balance brought forward is 500. Balance carry forward, 9,900. Take this here, 9,900. Okay, it comes to how much? 150. 17,150. Take this here, 17,150. It comes to how much? 950. 24,950. 24,950. Okay, which of three of the following will be key aspects of company receivables? Which key? Assessing credit worthiness, very important. You have to assess, is it credit worthiness of the customers? Is it right? Credit worthiness of the customers, very important. Checking credit count consistently, is it right? On a regular intervals. Is that I can say every 3 months. Is it right? 90 days minimum. Okay, say once in a year, no. Invoicing promptly and correcting, yes, you have to invoice promptly and you have to correct over debts. We should not delay it. Delaying payments, no, we cannot delay payments. Is it right? We should not delay. The credit policy is we should not delay payments. It's only 2, it's not 3. Is it only 2? It's not 3. A company is preparing its cash flow for the next financial period. Which of the 3 items should be included? Corporation tax payment, dividend receipt, short-term loss made on disposal. It is non-cash. A bad debt written off, it is non-cash. It is also non-cash. Provision is we have to take only cash items. Is it right? Cash flow forecast means answer is A, B, and F. For a retailer, let sales, purchases, inventory, closing inventory, receivables and closing receivables. Which of is the best expression of receivable days? Is it best receivable? What is the what we have to do? What is the formula of receivable days? Receivable days is nothing but closing receivables. Is it right? You have to take closing receivables. Is it closing receivables divided by sales times 365. Answer is this is R, this is S and 360. Okay. Which of the following is not usually associated with overtrading? What I told you about overtrading? Overtrading is nothing but you are spending less and you are borrowing more. Your current assets will be less, current liabilities will be more. Okay? Current assets will be less, current liabilities will be more. A increase in the current ratio. Is it right? A increase in the current ratio. A rapid increase in the revenue. Is it a rapid increase in the revenue and a rapid increase in the volume of the current assets. Most of the increase in current assets, and see what happens when it is over trading. Okay, when we are talking in terms of over trading, your inventory will increase. Is it? Your inventory will increase. Receivables will increase. Is it? Payables will also get affected. Okay. Now, when it's happening, is that you are purchasing more inventory, you are stocking more inventory, your receivables are, what happens automatically? What your current ratio will increase. Is it right? Your current rapid increase in revenue is not only one thing. It's all it affecting all. Okay, it is affecting all elements, not only revenue. Is it? It affecting all elements as such. A rapid increase in the volume of current assets, but also what your current liabilities will also increase. Most of the increase in current assets been financed by credit. Okay, financed by credit. Fine. But what happens? It's not only current assets; it is also current liabilities also. Okay. Answer is what? Answer is A. I will stop here, and in the next session I will start from question number 59. Okay, be continued. Subscribe the channel, share this channel, and if you find it worthy, like the channel. Thank you so much.